Thank you very much, Professor Henry Lee, and thanks to the program for giving me the opportunity to celebrate this remarkable institution and this remarkable person sitting next to me, Nnaemeka from ColdHubs. He's the founder and CEO of ColdHubs. He founded the Smallholders Foundation in Nigeria, which, amongst the many other things that it did, it also used the radio to deliver daily agricultural, environmental, markets, and social development programs to smallholder farmers in Nigeria. So next time you're in Nigeria, tune in to Farm 98.0 FM. And it's the first and the only radio program that's focused on rural matters and in general and agriculture in particular. Nnaemeka has many qualifications, and I have to look through the list of awards that are here, starting with Ashoka Fellow, Rolex Awards in 2010, the Fast Company's 100 Most Creative in Business Award in 2012, Nigeria's Young Person of the Year in 2011, the Niigata International Food Prize Laureate in 2012, the Yara Prize for Green Revolution in 2013, and most recently, the Wastelist Global Citizen Award of 2020. So, Nnaemeka, thank you for being here. We're glad, and congratulations for this remarkable achievement that we get to hear about today.
Thank you very much for having me.
Yeah. Also joining us on the panel is Morgan Richmond. Morgan is a senior analyst at the Climate Policy Initiative, a Washington-based organization that has done remarkable work in climate finance, and both directly as well as through other initiatives, one of which, again, Morgan plays a significant role in, which is the Global Innovation Lab for Climate Finance. So Morgan's work has focused on adaptation and resilience in particular, and that's something that we would love to talk about as well. She has done also quite a bit of work on cities and urban capacity for adaptation and resilience. So we'll be hearing about that as well. So thank you for being here, Morgan. And last but not least, Romi Bhatia, here from the USAID. He's the Senior Finance and Investment Advisor for the Africa Bureau at the USAID. He focuses on the implementation of the Africa Trade and Investment Program there. And before that, he also worked as Senior Credit Analyst at the U.S. Development Finance Corporation, as well as at SKS Microfinance some time back. So Romi brings a couple of decades of experience in development, infrastructure finance, and of course, African initiatives as well. So thank you very much, Romi, for being here. So with that, let me start with a conversation. I think the plan is that the panel can speak and first talk about ColdHubs, perhaps lay out some of what you've done, where you've been, perhaps then transition into some of the challenges that we feel, and using that as a way to sort of zoom out into a larger conversation about partnerships, about impact investing, about climate and social development goals, and about Africa.
Sure. So, that sounds good.
Great. Let's do that.
Thank you very much. So my name is Nnaemeka Ikegwuonu, and I'm from Nigeria, and I founded the company ColdHubs in 2015. Prior to setting up ColdHubs, I used to run the Smallholders Foundation, which was a nonprofit that did agricultural radio broadcasting. And in 2013, we were doing a radio show in the middle of Nigeria. The radio show was following the cabbage, and we're trying to document and also identify best practices in cabbage cultivation which we will now translate into the local language and broadcast to farmers. So we've done pretty much episode 1 to 18, and the last episode, 19 to 20, should be about marketing. So we waited till farmers were harvesting cabbage to go and ask them how was the marketing. So I traveled to Jos, Plateau State in the middle of Nigeria, and most of the farmers I met all were talking about spoilage. Uh, when I went to the largest cabbage market in Jos, everywhere was white and green. Everyone had a truck or a van full of cabbage in the market, but there were no customers. So most of the farmers practically left the cabbage there, went back home and bring more cabbage the next day. And I asked them really, what can be done? And they told me, if there is a form of storage in the market, we will be very happy to use it, store our cabbage until we get the customers who will buy it. And it struck me at that time that there is no form of cold storage to actually store fresh fruit and vegetables, cabbage, lettuce, tomatoes, cucumber, whatever in the markets and in the farms. So I got back and I told my colleagues at the Smallholders Foundation that we should try and do something. We were young people and we built a cold room with a window unit air condition. It was like crazy engineering. Nobody told us what to do. We just built something. We told it to 11 states of Nigeria, and most of the farmers said, this is very good, but we can't buy it. So what you guys are going to do is you own this technology and rent space. But the cold room that we were presenting was really very small, and they challenged us to increase the space. So we didn't have any refrigeration background. We were young people running a community radio station that did agricultural broadcasting. We went on Google and we searched and searched and searched. One day we saw a German research institute, the Institute of Air Handling and Refrigeration in Dresden. Actually, what led us to the institute was a PDF report of a solar-powered cold room done in 1999 with the German government funding, which was never commercialized. And I'm like, whosoever did that project is the people that we should be talking to. We saved money. I flew to Germany and I met Dr. Michael Goldberg and his team. And, I just walked into this research institute and they were like, okay, who are you and what do you want? And after several conversations, they took me to the backyard of the research institute where they have this solar-powered walk-in cold room. I remember them switching it on and it coming up. And I was so excited and told them, this is what we need back home. So we began a research. They helped us design this cold room. We finally were able to build one, and we decided that it needs to be deployed by a for-profit venture. So we got the name ColdHubs in 2015. Became a for-profit venture. It was not my intention to run ColdHubs. We raised money from the US, and our first equity investors told us, listen, we love this, your radio thing you are doing is very good. But if we give you 280,000 US dollar as a first equity investment to go and run the company, we are investing in you. So I had to leave the Smallholders Foundation to run ColdHubs. So ColdHubs became a company that actually designs, builds, commissions, and operates solar-powered walk-in cold rooms. And to cut the long story short, we are now running 54 ColdHubs in Nigeria, serving 5,631 smallholder farmers, retailers, and wholesalers. And we are now positioned to go to scale because we just integrated refrigeration transportation services as part of the offering, becoming Nigeria's first cold chain company. I miss my days on the radio, but this is a new calling that we are very determined to push, not only in Nigeria, but to other African countries. And that is what really gets me excited, the potentials of pushing solar-powered cold storage across Nigeria and other African countries.
Thank you. It's a fascinating story. So, and Romi, the USAID has been sort of part of this story right from the beginning, right? Some, implicitly in the beginning, and you're sort of like an anchor investor through grant funding, which you do at various stages. So, tell us a bit about, what this looks like from the perspective of, the innovation ventures initiative of the USAID.
Sure. Happy to. And thank you first for the invitation. Glad to be here at the Belfer Center, and I just love listening to Nnaemeka's story because where USAID operates throughout Africa, the true development work is happening on the ground by the people of that community and people who have the ingenuity, sometimes just the simplicity of Google searches, right, to be able to find solutions to problems that are affecting them. So I'll kind of zoom out in terms of what I do at USAID. I spent prior to me coming over to the agency, I did a lot of work in microfinance, so in rural development. For those of you that may or may not be familiar with microfinance, small loans provided primarily to those who are very, very poor to help them come out of poverty. It's grown to be more than just credit to a range of financial services. And that brought me to USAID because I saw the power of finance to be able to bring sustainable development, but when done with a focus on the community. At USAID, in different capacities over the years, one of the things I've done is always look at how the term is blended finance, how we can use our scarce, and it is scarce, even though it's a lot of money, it's in the billions of our foreign assistance to be able to go further. And what that means is at USAID, I worked for many years, and I'll mention a little bit about what I'm doing now, on providing credit guarantees. So blended finance is essentially, for those of you that might not be familiar with the term, the strategic use of public capital, so that's concessional loans or grants, to mobilize private capital. Nnaemeka and I were sitting there and I was asking him how much more money does he need now to scale? Because what you have is a gentleman here who's gone through all the difficult steps an entrepreneur needs to go through to have an MVP, have your proof of concept, and now you're starting to raise capital and you can't sustain this type of initiative, which he's already mentioned is a for-profit initiative on grant capital. You need private capital. The challenge is the prevailing financial institutions in his country and throughout Africa tend to see businesses like his, for all the great stories and successes and all these awards he's won, they won't extend credit to him. And why is that? It's both, most of it is, a lot of it is rooted in perception, but there is actual factual risk that they deal with. So there's always a risk return profile when a lender is looking to extend credit. They will, of course, want to take the safest decision to make sure they can get their money back. Nnaemeka, I'm guessing you don't have millions of dollars in your bank account?
Not at all.
Not at all. You have ingenuity, you have smarts, you got a team of committed people, but you don't have collateral, most likely. So that's one of the first barriers. Two is, and did you do a startup before this? You were at the radio station. So maybe that in itself was a startup, but then the banks look at track record. Well, he doesn't have that in the cold storage industry. So from all the perspective of a very narrow focus bank officer that he walks into a branch, they're not going to extend him credit. So one of the things that USAID has been doing for many years, now it's done under our US International Development Finance Corporation. Sorry for these long names and acronyms. It's DFC, is to provide credit guarantees, where we partner up with a financial institution and we say, you know what, for development, sustainable agriculture or logistics, or you name a sector, is really important for your economy to grow, but the businesses that are doing this work can't get the money that they need. And so if you're willing to lend to these businesses, we will guarantee the loan, half of the loan, not all of it, because it is a risk sharing agreement against default. So if Nnaemeka runs into hard times and does not have the cash flow, does not have the ability to repay his loan, the bank, the financial institution, we work with a range of them, has the ability to come back to USAID, and we manage it for the US Treasury to get 50% of the principal loss back. Real quick question. What do you think, how risky do you think that is for the US government to put our capital aside for lending to someone like him? Do you think the default rates are like for us, for businesses like his, without the track record, do you think it's over 5%? So it's surprisingly, our guarantees for loans defaults that we've had to pay out for, historically, even in Africa, is under 4%. So you wonder how, right? And so it gets to the point of how are they evaluating businesses like his based on an actual due diligence of the business to see, does he have the capacity? He was asked to run a business because the investors knew that they're putting their money really into him, not just the idea. Well, he will generally run into some challenges, and I'm sure he has many, but his ability, his perseverance to be able to repay his loan, that cash flow, servicing that debt is critical. And so this is what I used to do a lot in the past, we analyze the ability of banks to be able to assess these types of businesses. And the reality is most of them are viable businesses that are looking to scale, but end up suffering and oftentimes dying because they don't get the needed capital at the right time. So that's a lot of what I did in the past. Now, in terms of blended finance, maybe I can touch on it briefly. I did bring some handouts. Maybe it'd be worth sharing it with the audience here. Can I touch upon that a little bit, Akash? Okay, so I mentioned blended finance is a range of tools that the US government, in this case USAID, can use to mobilize private sector capital. So one is, as I mentioned, credit guarantees. Another is using our grants, not to fund Nnaemeka's project per se, but to serve as first loss capital to a fund, an impact investment fund that wants to invest in a whole number of ColdHub type businesses. ColdHub, right?
Yeah.
Sorry, I'll make sure I have the name right. So let's say there are 15 other social impact businesses like this that are working, sustaining, doing it profitably. And there's a fund that wants to invest in this. And there, by the way, there are funds throughout Africa, African funds, as well as US-based funds that are already doing this. But how do you attract commercial capital to these funds? Well, again, we get back to risk perception. A US investor may say that, I don't know if we'll get our money back. Now we're talking about equity and not debt. So what we do at USAID, and the handout that hopefully there's enough copies for everyone, is, so we'll take our grant, 500,000, and instead of giving it to 4 or 5 businesses, we give it to a fund to serve as first loss risk capital. So in case of default, so investors are always looking at risk return profiles, right? So what's the least riskiest investment you can have, right? What's a risk-free return? Treasury bills, yeah? So that's the easiest thing. You know you're gonna put your money and you're gonna get your money back, but you get a very low rate. And so, sorry to go into a little bit of math here, but like just, you know, your economics, you have your risk return profile. As you go up that slope of risk and return, the riskier a project is, the more returns an investor wants. So what we do with the first loss grant capital is we tell the fund to use that so that should there be a default, the default part of that portion of that will come out of that capital pool. So in essence, we lower the level of risk for that particular investors. And so what you have in front of you is a practical example of this. In East Africa and Southern Africa, we have partnered with Third Way Partners and the Nature Conservancy to focus on, actually they're focusing on, we're supporting their focus on 20 to 40 safari tourism operators that are gonna be creating jobs and livelihoods for the family and supporting them while also protecting hectares of land. And so the way that's being done is by third way partners establishing a fund. USAID places its grant capital, plus provides technical assistance to help the fund get structured. So basically, we're lowering the barriers for a commercial investor to go in, whether that is the feasibility study or the loss of risk capital. And this allows impact investors to come in. And I just spoke to the managing director of that, and I said, how is your fundraising going now? Because they're using our USAID grant capital to raise $20 million of what will be a $75 million fund that will invest in businesses like Nnaemeka's. And I'm sure you all read a little bit of the news. You know, we're in a very high inflationary environment. The Fed just raised their interest rates again today. So do you think an investor in the US is thinking about investing in Africa right now? Yeah, no, right? So I asked Martin, the managing director of Third Way Partners, are you struggling to raise capital? He said, Romi, actually, to my surprise, we're going to be able to close by the end of this quarter, the 20 million that they're looking to raise, which again, then will go to these 20 to 40 safari tourism operators. And he said the reason we're able to do that is because the USAID support is allowing us to be able to reach investors who otherwise would not have considered investing in Africa. So much, and I know Morgan will touch on this, so much of the need for capital in Africa is overlooked because of risk perception. Now, there's some real risk there for sure. I don't want to negate that. But a lot of developing countries, in terms of investment grade, are B minus and below. And in Africa, oftentimes the perception is you're going to lose your money, you're not going to get it back. And there are thousands of stories like Nnaemeka of individuals, entrepreneurs who are trying to grow their businesses, but when they need capital, that's the key. And they need patient capital too. It's not necessarily a loan in some cases. You may want to pursue a loan later, and maybe that institution might be able to support you through one of our care guarantees. But what I'm mentioning in the case of Third Way are individuals, impact investors in the US that are putting money into a fund that's going to be an 8-year fund. So it's a longer term horizon to give businesses like Nnaemeka's the opportunity to grow and scale. And so I just wanted to share that case study because blended finance can be a vague term for folks, but this is an example of kind of how we're doing it across the region through this Africa Trade and Investment Program that I oversee. And our goal is, again, to work with private equity funds to get them to invest on the continent across sectors, but to do so and help them de-risk, but then also make sure they're prioritizing areas of development. Because it would do no good that if money just went to businesses that don't need it. But these safari tourism operators, as I'm mentioning, are generating economic growth for their local community. And that money circulates. And that is really critical for the long term. So it took probably a little bit more time than I was thinking to, but it got me.
That's all right. You've given us a good.
It got me to think of different elements of where finance can actually be, when the tools are properly used, can really help businesses to help them thrive like that.
Absolutely, no, you're right on mark that risk perception matters a lot, and de-risking is a great is an important step in that direction. And I'm particularly impressed by how much what one would think of as a USAID or similar organizations that were for the longest time primarily grant providing organizations are doing. And that's where I want to sort of go in the finance landscape. I know that Morgan, you have done, and your institution has done remarkable work in that landscape of climate finance that you have put together. Is a remarkable piece of research. But one of the things that I took away from there, one of course was how little is available or has been mobilized compared to I think if I remember the numbers correctly, it is less than 10 cents of the dollar has been mobilized or something or along those a few hundred billions compared to the trillions that we need. But even within that, a few things struck me. One was how small a sliver grant financing had, right? And most financing comes in the form of debt and equity. And about half of it has come till now from the private entity, and probably a lot more needs to come in there. One of the things also that I found remarkable in the ColdHubs story was that you all started with equity financing rather than grant financing, right? Which is quite a bold move, if I may say so, right? I mean, because the equity financing comes a little bit later, but perhaps in part thanks to the kinds of structures that you were talking about, Romi. But there is this, so there's a risk perception, but then there's also a landscape of investors, right? So the grants tend to be small, small ticket items, lot of skewness in that some venture capital of the type that ColdHubs was able to tap into, and but you said you raised $280,000 from there, right? And that's $500,000, maybe at most $1 million is what you would get. And then there is the other end of the spectrum where the IFCs and so on, they provide you with tens of millions, right? 10 million, 15 million, and so on. But there is this phase, which is sort of 2 to 4 to 5 and less than 10 million, right? And that has been called the missing middle, right? You have a great sense of the landscape. I just was wondering, Morgan, if you talk about that and some of the attempts that have been made to get into that piece, some of which we already got started on. Blended finance, certainly one way to do that.
Sure. Yeah. Thank you. Well, I'll speak to the global landscape first, since you mentioned it. So, Climate Policy Initiative is a research organization, and one of the products that we put out each year is the Global Landscape of Climate Finance, which tracks global climate finance flows, global climate finance commitments. And you're exactly right that there's a slight lag given reporting, but in 2019, 2020, about 600 billion flowed annually to climate finance solutions globally, including all climate finance solutions, which sounds like a lot, except in the context of the need. And of that, about just under 50 billion tracked went to adaptation and resilience finance. So the solutions that are responding to climate risk, mitigation finance being renewable energy, carbon capture, et cetera, and then adaptation and resilience being sort of the other side of the coin. So a sort of 10 to 1 also, even within then the adaptation finance space in terms of the flows, which again, 50 billion maybe sounds like a lot, but compared to the amount that's needed to respond to oncoming and accelerating climate risk, it's not nearly enough. So that's sort of the context that we set. And then CPI is also the secretariat of the Global Innovation Lab for Climate Finance, and it's sort of through the lab, which is the lab for short, that we're kind of 2 degrees removed from ColdHubs. The lab is an incubator program for climate finance instruments. So description of climate finance instruments already done, which is great. Some of the kinds of instruments that we're supporting are servitization mechanisms, results-based bonds, debt instruments, sort of the whole gamut. The lab operates on an annual cycle. We're just entering our 9th annual cycle of the lab. So it began in 2014 as an initiative of the US government, the UK government, and Germany, and now is a partnership of 60 plus institutions, governments, development finance institutions, other kinds of public and private capital, academic institutions who all come together. CPI serves as the secretariat, staffs the lab, and it operates on this annual cycle where folks apply to the lab with innovative climate finance instruments. The call for ideas is actually open right now. It just opened about 2 weeks ago. It will be open through the fall, and it will close at the end of the year. We then, and so anyone can apply with a climate finance instrument, an instrument that's targeting any sector of climate, so renewable energy, energy efficiency, land use, adaptation and resilience. It can, cross-sectoral is great. The membership along with CPI then looks at the 100 to 300 applications that come in January and February, selects a cohort of 6 to 8, depending on the year and the priorities, and supports them from March to September, sort of a 7-month support process where we help the proponents think through a lot of the challenges that have already been discussed and work on financial modeling, target markets analysis, think about other comparable instruments, and if there are lessons to be learned from a private equity fund in Vietnam that could be applied to a new private equity fund in Ethiopia. So that process extends through September, through centralized support. And then at the end of September, the ideas that have successfully gone through the process are endorsed by the lab, by that membership. And until that point, they're receiving in-kind support from the lab. So it's not direct funding, it's all in-kind support, both from the Secretariat and from the membership. And then they sort of go out into the world to implement with the continued support of the lab. The connection to ColdHubs is that in 2019, one of the ideas that came through the lab was called Cooling as a Service. And it came to us from the Basel Agency for Sustainable Energy, which is a Swiss nonprofit. When they came to the lab, their idea was mostly focused on servitization of cooling for commercial buildings, for airports, for hotels, et cetera. And they had sort of started to have an inkling of application of efficient cooling in the ag sector. But most of our thinking with them was much more sort of commercial cooling focused. But we got them, they already had this great idea, and we helped them think through what funders should they be interacting with, what would a financial model look like, what could be a recapitalization structure for a cooling provider that's interested in cooling as a service, but doesn't have enough finance on the balance sheet to servitize their cooling without some recapitalization. And then they went out into the world and have continued to implement in a variety of contexts, including increasingly in the ag sector, where they're implementing in India and in Nigeria. And Nnaemeka could speak more to this than I can, but have then made the connection with ColdHubs and have been supporting, my understanding is largely sort of in the digitalization space in support. So that's an example of how the lab sort of takes these ideas, operates with them on this annual cycle, and then aims to help them out into the world to respond to some of these same challenges that we've been talking about. I'm happy to talk about other elements of the lab and other ideas that have gone through, but I'll stop there.
Thank you. Thank you. Thank you very much, Morgan. So before we go to the broader, I want to sort of come back to ColdHubs for a moment, and to also inform the audience that for the Roy Family Award, this award looks at the different initiatives, and we get a large number of these examples from around along 4 criteria. One of them is innovation. The second is effectiveness. And Nnaemeka, you've already talked about a little bit about that. Another one is significance of this, and I think it's valuable to know that by one estimate, 40% of the food gets wasted because of lack of storage solution in Nigeria, and globally that number is somewhere in the range of 25 to 30%. So it's quite a remarkable and significant intervention that we are talking about here. And of course, then the fourth one that comes in is transferability and scalability, right? So you are now at the stage where you are going into sort of the next stage where the proof has worked. It's environmental contribution, it's social contribution, it's economic contribution, it's viability. Something else that I found remarkable is that each of these sort of units become self-sustaining within a year, right? So you are sort of at that point where you need to move to the next stage, both within Nigeria and also expand. So talk a little bit about where are the challenges, where are the opportunities for you, or more broadly for people who are in this field.
Thank you very much for that question, Akash. Really, we have been able to deploy 54 ColdHubs since we started, and Nigeria is a very large country. There are estimated 200 to 250 million people. So our estimate is that you should have close to between 50,000 to 100,000 ColdHubs for the Nigerian food sector alone. Not only for the fresh fruit and vegetable sector, but for fish, meat, milk, wherever you need, and for pharmacy, which we have started seeing recently for pharmaceuticals a lot. So we've been on the road trying to raise money. Good thing is that we raised an equity in 2015 together with a grant from the German International Corporation at the same time, whereas the grant from GIZ was meant for us to do a prototype of what ILK Dresden designed. The equity investment, which we got as part of an incubator program that we joined, was really to deploy some few units. But when we came back to Nigeria, because that incubator program was in Seattle in Washington State, and I spent 3 months there learning how to run a business. I was a radio broadcaster. I had audited annual reports, financial projections, all the financial terminologies for the very first time. I didn't know what was going on. So gradually it started to sink to me that you will run a business. So you need to know how to run a business. But when we came back home, some of our Nigerian mentors told us that we sold out equity of 27% of the company for so little. And they were like, it will be very difficult to raise additional money because you've already sold out quite a bit. And these Nigerians knew the environment, and they told us that what you guys are trying to solve is a huge problem. You will make money out of it. So try and build the company leveraging on grant financing. Don't talk about equity or debt again, And that brought us to USAID, where we were very fortunate with Feed the Future, Partnering for Innovation for $500,000 raise in grant financing to do 20 ColdHubs. We went to Swiss Re Foundation. We joined all innovation competitions. Anywhere we see innovation competition on climate, on food, we go, just to go raise money, and we succeeded. So we raised about 3.5 million in grants, and that was really to position the company so we can have traction, market presence, and very solid valuation that we can now use to go in. So we got to that time where we felt like, yeah, we've made it. So let's go and raise money. So we spoke to Microsoft, Climate Ventures from Microsoft, and they were like, how much are you guys trying to raise? And we say, 4 million. So, oh, no, we do 50 million. Very small. Then we went to IFC, and IFC was, how much are you guys trying to raise for the next one? And we said 4 million. And they were like, okay, you know what? Send us your newsletters so we keep in touch. When you guys want to do 50 million, come back, okay? Yeah, so that was it. So we went to different places, and it was like, here we are looking for between $2 million to $4 million to really consolidate on the Nigerian market, and there were no organization that was ready to give that kind of money, whether in grants, which was totally difficult, in debt. They look at our revenue, it was very small, and it was like, no, it's not a go. They look at the equity and they say, this company needs to run for a couple of years more so that the valuation can increase significantly. So when we come in, we are not taking the whole equity. So we got stuck. We've grown with grants to some extent where we have some traction. We need to move to the next level of a $4 million raise, but you see that you are not qualified for 4 million, So the missing middle is really important, and I say this everywhere I go, that there is where you grow to as a startup and you need money to go a little bit higher, and there is no money. And not a lot of startups know that there is a missing middle, and you need that 2 million, 4 million to take you a little bit higher, but it's not available. I don't know how to solve it. I don't have any suggestions on what can be done, but it's something that everyone can discuss in this room, because it's stifling growth, is discouraging scale, it's also affecting team, because, the excitement of being in a startup team is that you see scale. It gets really exciting. But when in 1 or 2, 3 years, you don't see expansion, people start looking for what we call in Nigeria, greener pastures. They start leaving the company because they don't see that growth. So we at that point, luckily we started speaking to a couple of philanthropy organization, and recently we closed on a $4 million raise from King Philanthropies. It's considered a seed round. Out of the 4 million, 1 million is considered a convertible debt. 3 million, we are still figuring out the financial instrument for that investment. You see, even at that level, no one knows the financial instrument for that investment. So we are still trying to say, are we going to do it as an equity? Okay, what's going to happen? So it's really a very tricky thing in the startup space. And if I didn't know about it in 2015, I thought that, once you get to the stage we are, where we have traction, you can actually raise any amount of money. And I found out that it is very difficult to raise up to $4 million, but relatively easier to do 15 million. Yeah. But we are not on that stage of 15 million yet.
Yeah. No, that's an excellent question. And my understanding is you're not the only institution that is seeing that gap. So let me, before I turn this to the audience, let me just ask my two panelists to comment briefly on this missing middle. Will it be an upscaling of the grant space, perhaps using some kind of blended structures, the type, Romi, that you were talking about? Or will it be commercial finance that will actually scale down into the 3 to 5 million space? Because that's the space that is needed to move to the next point. So, just your brief thoughts on that, and then.
This is such a difficult nut to crack. I mean, what Nnaemeka is dealing with, we have tried. I mentioned credit guarantees to you all earlier. But sometimes it's to no success. We cannot get the bank, we cannot convince the bank. Our role is not to tell the bank who to lend to, even though his is a viable business. We provide the credit guarantee, and for liability reasons, they do what's called the underwriting. And even with a credit guarantee, changing the mindset. So this is not the CEO of the bank or the C-suite folks. It's the loan officers, the people out in the branches, to get them to understand and how to understand and evaluate his business and other small and medium enterprises, SMEs. Most tend to be in the small and not in the medium category, and there's a definition for that distinction. But the challenge has been, our approach has been both, but upscaling grants has limitations because with USAID, earmarks, Congress, foreign assistance, priorities changing, you cannot rely on that. So my role in the agency is to always be looking to the external private financial institutions to see who we can partner with to support businesses like Nnaemeka's. So providing credit guarantees in some cases, I've seen it because they just haven't been utilized, meaning even though we put the guarantee in place, they're still not lending to the businesses like his. The other opportunity is to find impact investment where you have like the Calvert Foundation, the Calvert Impact Assets. They're based in Washington, D.C., but there are many others like them that are willing to lend or provide capital for longer time horizon. I say lending because they provided concessional, so below market rate, because again, Calvert has a way of raising money from individuals like yourself, and then they in turn pool it and invest it. So you're not getting more return, but they're not putting an onerous interest rate on Nnaemeka that, okay, he got the $4 million he needs, but it's at such a high interest rate. Now they're scrambling to generate the revenue to service it. So the space is, you mentioned the philanthropies, the space is the impact investment space, but that still hasn't fully matured. And there's just a greater demand than there's supply of that capital. The example I mentioned with Third Way, there's a way to apply to USAID under our ATI program. There are 5 other funds that I'm evaluating right now. I can't mention their names yet because we're going to announce them at the Africa Leaders Summit in Washington in December, but they're focused on impact entrepreneurs or just entrepreneurs in general. One of them I can mention because we worked with them in the past is Endeavor, and they have a South Africa office. USAID supported them in the past, and they've lent to African entrepreneurs throughout the continent. So that is where the space, where the capital right now to address his need, he has to go, because until the commercial, where a lot of the real capital is, until the commercial lenders and investors recognize that this is not as risky as of a business, they're going to sit. So everybody's going to sit on their hands and wait until he gets to the revenue target they want. In the meantime, I sure hope it's not going to happen. I don't think it will happen. I'm confident it won't happen because he has the resiliency. But businesses like his may not survive. So it's a terrible state in the U.S. if you're a small business, if you want to start a business, there are many places you can go to for capital. Of course, the cost of that capital has gone up recently, but in the African context, many other developing countries that I've been in, it's usually, if it's not a microfinance institution, which is very small, it's not very, very small loans, not the size of what he's looking at, scalable business, then there aren't entities to serve the, I guess what I'm trying to get to is, there aren't entities to serve the missing middle market. We have to rely on incentivizing commercial lenders, banks, other types of financial institutions to give them a second look with a guarantee. Sometimes it works well, sometimes it doesn't. But a lot of that is dependent on that financial institution and their willingness to really commit to that. So I'll leave it at that. It's a struggle. So I can't say we have a solution to it.
Morgan, you want to take, and let me add sort of one more piece to this, based on Romi's comments, is greater and earlier focus on impact, and not just focus. By focus, I mean intentionality of impact, measurement of impact, calibration, and displaying that, the demonstration of that. Is that the way to greater ability to achieve bankability? Might that be particularly, Romi also threw in the philanthropic side on this, but also commercial lenders who are looking for impact.
Yeah. Yes, I think so. I think, sort of everything is probably part of the solution, but I think you're exactly right. And just to confirm that we see the exact same gap. So that gap that we've all been describing is certainly encountered in our work too. And part of the goal of the lab, or certainly an interest of the lab, is when folks apply to the lab with ideas for investment vehicles that are targeting that ticket size. That's of significant interest because we know that there's such a gap at that ticket size. So that's the kind of thing that we're looking for in the lab context during selection, not just CPI, but the whole lab membership, including USAID as a lab member, and the institutions that are lab members also know that it's a gap. And so anyways, that certainly has informed vehicles that we've worked on in the past, including private equity funds that are targeting SMEs and others. On the impact piece, I think you're exactly right. And I think proof of that to some extent is that the hardest sector, one of the hardest places to get climate finance is to adaptation and resilience. And I think one of the reasons that it's so hard to drive finance there, especially private finance, but really in general, is that impact metrics are so challenging in adaptation and resilience. Impact metrics are challenging in all sectors of climate finance, but at least in mitigation finance, there's some level of a uniform CO2 equivalent, CO2 abated. There's a metric, whereas in adaptation, there's sort of movement towards something to the effect of people made more resilient, but much harder to measure than CO2 equivalent abated. And it depends on the climate scenario in question and the time frame. And so anyways, because of that challenge, it's much harder to get investors, especially concessional investors, into adaptation projects, I think, because there's such an interest in being able to measure the impact. And when it doesn't seem possible, there's a shift back to just do the mitigation projects that we know is important and where we know we can measure impact more confidently. And so I think, yes, in that context, sort of for all ticket sizes, not just for the missing middle, but for scaling all climate finance, starting early on thinking through impact measurement frameworks and figuring out what your baseline is and what are the right metrics is super critical, so that from the beginning, you have the most likelihood of access to lots of different kinds of capital, including the kinds of capital that are most likely to value having those metrics and having them set from the beginning.
Thank you for that. I should also mention one other thing. I keep coming back to that picture, but if there's a picture that's worth 1,000 words, then that one is it, right? Which talks about and one of the things that also struck me in that picture was how small the amount that is mobilized for mitigation and for adaptation and resilience is compared to mitigation, right? I mean, it's again less than 10 cents on the dollar, and again partly to it. I can go on, but I think I should turn to the floor and invite people from the audience to ask questions. There are 2 microphones, so do identify yourself and your affiliation, and identify the panelists that your question is directed towards.
Hi, thank you. My name is Muriel. I am originally Brazilian, student at the Masters in International Development, and I spent this summer working in South Africa in venture capital, Series A and Series B. So it was in the middle was a very real problem. But I'm just curious on the point about adaptation finance. A lot of what I heard over the summer is that it's very challenging because there's not a lot of proof that adaptation on climate can have a return on investment. So I'm curious on how do we are able to have a conversation and not make adaptation necessarily just grant giving at this point. Thank you.
Sounds like Morgan.
Yeah, I can start and happy to have others jump in. Yes, good question. It's something we're thinking about sort of all the time. I think there are avenues for private investment in adaptation and resilience, but I think you're right that it is a huge challenge for all of the reasons already stated, for the lack of climate risk, underlying climate risk analysis in some places, or even maybe in most places, that makes figuring out what the right climate adaptation action is, the sort of optimal climate adaptation action, really challenging. I'll just offer one example, and happy to talk afterwards about other sort of systemic changes. But one example actually that came through the lab is a equity fund, a growth equity fund called Craft. It came through the lab process in 2017. And it's an investment fund that is investing in adaptation resilience solutions providers. So SMEs, some of which perhaps previously wouldn't have identified them, called themselves a climate adaptation solutions provider, but that are responding to climate risk and are offering climate intelligence services. And Craft, which is US-based, reached a final close at a little over 180 million in 2020. So a good proof of concept that there's interest in, at least in this space. I think there's so many different kinds of climate adaptation. I think there's real opportunity for private investment in climate intelligence solutions and services, and in resilient infrastructure, for example, in commercial applications of resilient agriculture. And there also is tons of what we would think of as public goods that need to be made more resilient, and where I think the challenge is existent and large. So I think there's real promise and stuff that is happening in adaptation finance that is drawing in the private sector, and a huge gap that you have identified. I don't know if you have anything you'd add.
I think that's really hits on some of the major challenges.
So if I can just ask a sort of a follow-up to that, Morgan. So when I look at adaptation benefits and resilience benefits, in some ways I can draw a boundary of where the benefits accrue much more easily than I can with mitigation benefits. They are much more widespread, right? Is there a way to convert those benefits into a financing option? Because those benefits, if I invest in making my house on the beach more resilient, I mean the benefits. So in that sense, the benefits lie pretty close to the private entities, particularly in terms of mobilizing private finance for these.
Yeah, a good point. You've given me the opportunity to talk about another lab instrument. I think that question is like the holy grail of adaptation finance, or one of the holy grails, figuring out how to monetize the resilience benefits when they accrue in a relatively circleable place. A financial instrument that came through the lab this year is called CILRIF, Climate Insurance Linked to Resilient Infrastructure Finance. And the goal is very similar, I think, to what you're describing, which is that the goal would be to offer municipal climate insurance linked to resilient infrastructure financing. So financing of, in this case, mostly municipal infrastructure, whatever is needed, raising of roads to respond to flood risk, hardening buildings to respond to storm risk. And the idea, the goal would be to link that to the premium that the city would pay on their municipal climate insurance, that because they had invested in resilience, the pricing of the insurance would be affected. And actually, likewise, their access to insurance, the idea is that having access to insurance would also lower the cost of the financing on the resilient infrastructure financing. It's early stage, it's in pilot, it's proposed by UN Capital Development Fund, who's moving it forward with a working group. So that's an example that they're trying to do exactly that, think about how to monetize and price the benefits of resilient action.
Please.
Can everyone hear me okay?
Yes.
Okay. Hi, my name is Ashley Burkhardt. I'm the Chief Scientific Officer of Germinate Ventures, and I'm also an associate at the Environment and National Resources Program here at Harvard. So I am just commenting, first of all, from the VC space. I think there are all of these different types of financiers that come in at different levels. We do seed and Series A. The issue is finding the network. And then the issue is also pattern matching, because VCs tend to continue to invest what they're comfortable in. And if they haven't invested in Nigeria, they're not very comfortable in it. So how do you break these habit loops, I think is one big story. That's why I have put you in touch with someone who I know who specifically invests in Africa, in Nigeria, in supply chain, and in food and ag. So to find those kind of intersections all come together. But that being said, being in VC and the fact that I do invest in food and ag, I can't help but think of one risk that we haven't identified here, and I'm going to ask it. So it's going to be kind of aimed at multiple people here. I look at it as farmers are your main customer, right? And farmers are struggling harder than ever, especially in the US. Right now, US farm income is down by 50%. It's starting to go up again, but I can only imagine Africa is probably in the same situation. And so here you are providing a solution, which is fantastic, because you're going to be, improving their profit down the line by preventing this post-harvest loss. But a lot of them don't have the capital up front to pay you. So when it comes to these new enterprise models, we don't need to just think of how are we financing you. We need to think of how are we going to finance the farmers, because really this has to come down to a farmer first policy and how this becomes profitable for the farmers. And that's the only way we're going to get adoption. And that kind of will trickle down to everyone. So I'd like to hear your comment on that.
Thank you, guys.
I'll mention a couple of things. Our administrator, Samantha Power, just announced this recently. It's the Zambia Trade Boost. And essentially what we're trying to do here is looking at the spillovers of the Ukraine crisis and how it's obviously impacting and will continue to impact the African continent. So it's a case of us working with farmers and traders to be able to get supplies to where they need. But the challenge is that they're grain farmers. And so the challenge is getting them to have at the point of delivery, payment in a timely fashion by the traders, so then they could be kept, that product could then be sent to some of the other food deficient countries in Africa. The approach we're trying to take there is work directly with the farmers, to your point, because if the farmers don't get paid in time, we're talking about livelihoods, it's immaterial whether or not the traders can get the product to the right markets, because we're not addressing the root point. So again, not to come back to the whole guarantee facility piece, but we are working here with the traders and the farmers, providing direct payment to the farmers, having the supplies be kept in warehouses where we can make sure the collateral, which the traders are going to then use to be able to sell it to different markets, is safe and verified to then get it to where it needs to go. There's just so many parts of that chain that need to get addressed, but the farmers are usually the ones shortchanged. We're just starting this now. Obviously, one could argue we could have been doing this earlier because of the food crisis, but that's one thing we're trying to do right now in Zambia. I can share more with you offline about it, but it's just the first thing that came to my mind in terms of working directly with farmers and in the whole supply chain. But yeah, I think Nnaemeka, I'm curious to hear what you think.
Thank you very much, Ashley. I think we need more of those VC networks to come together and also to gain geographical understanding of the market in different countries. So we need more of such networks. And thank you very much for putting me in touch with someone who has invested in Nigeria and understands the Nigerian market. The work we're doing, I think farmers needs to be empowered, but the supply chain, right from when the food gets harvested, most of the food gets mopped up by wholesalers. the wholesalers actually distribute the food to the markets. You have very few farmers who bring the food to the market. So when we set out with ColdHubs in 2015, we felt like most of the cold rooms will be in the farm clusters. In the course of deployment, we discovered that most of the farmers, before they harvest, they actually connect with the wholesaler. And once they bring the food, they want it to be moved out, to be purchased by the wholesaler as quickly as possible. So we changed that thought process to moving more cold rooms to the end of the supply chain, which is the outdoor food markets. In the outdoor food markets, we've discovered that the most powerful cartel are the retailers and the wholesalers. They pay the farmers so little. If farmers are empowered, they can actually purchase cold storages, but these wholesalers and retailers make sure that such infrastructure, farmers don't see the usefulness of such infrastructure so that they can buy up the products at very reduced rates. So we've signed up so many wholesalers and retailers. But in March this year, we started refrigerated transportation services. And we discovered 2 layers of customers, farmer cooperatives, 15 to 16, up to 20 of them coming together to rent 1 10-ton truck, and new B2B customers, including very high-end hotels and restaurants, and they are paying so much. We didn't know there was so much money from those sides. So we just want to have more trucks that can move food for them. So what we are doing is really connecting these farmers to these high-end purchasers of the food, which is really, really good. We are connecting farmers to a restaurant in Lagos that actually buys the best tomatoes for their clients, which is a new ball game for us that we're also trying to learn. But I completely agree with you that, we need to invest in the farmers as much as possible, because as you are investing in them, you are also improving quality of product.
I also remember reading somewhere that your intervention for those 5,000 smallholder farmers has doubled their average household income because of the spoilage that is now saved, in addition to sort of the health benefits. And when I was doing that, I was reminded of actually some work that was done here at the Kennedy School quite some time back about small fishermen on the Indian West Coast. And these fishermen, bring in their catch every morning at dawn, and they have to sell that before the sun comes up because the fish starts to perish at that time. And the intervention there was cell phones, which was very new at that time. And they could negotiate prices with people who were not physically present there. And that had a remarkable impact on the ability. So I think there are these interventions which don't have to necessarily be transfers, but enablers of various sorts that give farmers access, reduces waste, increases market access, which are promising here as well, right? Yes, please. Yeah.
Very much. Alex Clark, University of Oxford, but I used to be a colleague of Morgan's, including working on the landscape and the lab. So it's nice to see you again, Morgan. I've got 2 linked questions. They're both fairly macro. One's at the national level and one international. So there have been a couple of examples, quite successful examples, although short-lived, of governments. I believe it was the government of Uganda, but it may also have been Tanzania, setting up venture capital funds at the national level, publicly capitalized, that were specifically designed to deal with this ticket size gap, valley of death. There are all sorts of different names for it. And for political reasons, they didn't last very long. But as a general principle, I'd be curious as to the panel's views on how viable this is. At the international level, of course, there's an acute need to get funding flowing now at scale. But no one really wants to talk about the Bretton Woods institutions and their role in all of this. I think, the IMF has been ignoring climate for a very long time, and things are really starting to change in the last 2 years, which is great. There's no secret the World Bank is a big problem at the moment. But I just wondered whether the panelists might share their thoughts on what the long-term goal should be in the reform of these institutions as well, because it's so clearly needed. as a way of getting the big money in the direction it needs to go? Thank you.
Big questions, I think. Let's whoever wants to jump in with that one first,
I
right?
have thoughts.
Go ahead, Romi.
I always have thoughts on all kinds of topics. Two examples. Thank you for your questions. One, in terms of something that I'm currently working on at USAID, I was mentioning about capital markets in these countries. So we're working with a lot of the sovereign wealth funds in Africa. In fact, 22 of them had a meeting in Washington, D.C. And this doesn't get to the value of death challenge of these SMEs, but these sovereign wealth funds, for those of you who don't know wealth funds, their focus is obviously preservation of capital, but these wealth funds have a development mandate, right? And what they're struggling with in many of these African countries is that up until before the pandemic, I want to say this changed, but there were only 4 investment grade countries in Africa. So that's the rating of BB or BBB. That makes it very difficult. So like an institutional investor, like a US pension fund that wants to invest in Africa or co-invest with these sovereign investment funds finds it challenging, because even if they think Nigeria, they want to invest in Nigeria, they see projects, the challenges of the investment rating. So one thing that we're working on is with these rating agencies is to have a more thorough look at all the different metrics for how these ratings are done, to see how it may or may not unfairly impact the sovereign credit rating, because that then spurs a lot of whether or not investment goes in or not. The other is, there was a recently formed association, African Sovereign Investment Forum, and we're looking at co-investment opportunities with institutional capital from the US, because it's really where the private capital rests, and which leads me to my second point. But that's what we're trying to spur to come and invest in the continent in a co-investment approach. And again, spending the money and the resources on whether it's feasibility studies or helping strengthen the capital markets in these countries. We at USAID have been part of a US government dialogue on MIB reforms. The multilateral investment institutions need reform, goes without saying. There's a bit of a struggle right now with that in terms, especially when it comes to climate financing. There's a dearth of it. That challenge is ongoing, of course, but again, it'll be announced probably next Wednesday at COP27. Several initiatives USAID is doing with other donors and other international organizations to increase climate financing, knowing that the broader reform efforts are going to take a lot of time. I'll leave it at that. Unfortunately, that's kind of where things are. But you might, Akash, you might have thoughts on it, given your work. But
I can go briefly. Because I worked with Alex, I knew it would not be an easy question to answer before you step to the mic. I'll just answer from the lens of climate adaptation and resilience, because I think it's what I know best, and offer 2 thoughts. One, for the national governments, is I think it's really important that national governments align their national adaptation planning with budgets, with actual national budgeting, and that external institutions and development finance institutions, et cetera, support that alignment and support the development of really excellent national adaptation plans that then can be put into action. So that's just from the adaptation side. And then for development finance writ large, including IMF and World Bank and all the rest, I think at a baseline, incorporating climate risk into every decision that is made is a starting point. Obviously, that requires understanding how you want to do a climate risk assessment, has its own whole complexity. But I think at the very baseline, from the adaptation side, starting with physical climate risk and understanding it for every investment decision that you make is a start. So I'll leave it there.
Do you want to add something to that?
Just real quickly, I think Ghana had a VC agency set up by the government. You might want to look at what Ghana did, and that agency, they have some financing from the government to invest in VCs operating in Ghana. or that has interest in Ghana, and then, follow on investment into startups, that model seems to be the only functional model that I have seen. Other models or attempts by African governments have not been successful because of political incursion, finally, So aside that, I don't think government has any role to play in bringing VCs together. I think these things can happen organically, just like Ashley mentioned, where VCs talk to each other and decide, like, we understand this geography, we understand this market. Let us have a small network of 1 or 2 VCs, and gradually it expands. I think that's the model that should work, and government should not have that role. But the Ghanaian experience is something that anyone interested might want to look into, and how they were able to do that. I think the Bretton Woods institutions needs quick reform. There's no doubt about it. As quickly as possible. And the fact is that in the next 10 years in Africa, for the agricultural sector, it will be driven. Whatever growth that we are going to see in African agriculture will be primarily driven by private sector. There is going to be a new climate perennials across Africa. That I'm certain, because young people are coming out of the universities launching startups. Some of them are fizzling away, but those that are surviving are very resilient. And I don't think anything will make them go under. So the Bretton Woods institution should quickly understand the wave of entrepreneurship, sweeping across Africa. And I use Africa as an illustration because that's my continent where we understand what is going on, and, open up windows to engage these enterprises as quickly as possible. Such windows, whether it's going to be additional climate financing, fantastic, whether it's going to be encouraging policy change. I was on an interview today, and I told the journalist that, when she asked about government support, and I was planning to say that we have not received any support from government. Instead, we pay a lot of tax to government as a startup. So there is a lot of support that the Bretton Woods institutions can actually help companies like ours to benefit from our government in terms of policy. It mustn't only be financial instruments. Simply reducing the 20% tariff we pay at the seaports when we bring in our batteries will help us a long way. Reducing 25% import duty we pay when we import our compressors from Germany will also help us a long, long way. So that becomes capital that will be invested in other activities of the company. So we are battling policy every day.
Thank you, Elko. I think we have time for one more question. Please, go ahead.
Hi, thanks so much for being here. My name is Carrie. I'm a joint degree student at Harvard Kennedy School and Harvard Business School. And I have 2 questions, if that's okay. The first question is on the missing middle, which you talked about a lot, and I agree is a huge problem. I'm curious to hear your thoughts on how this works at the fund level, because I think the reason why a lot of investors would prefer to write a $10 million check over like a $1 million check is because like the cost of doing the deal are the same for those investors, like regardless of the check size. And so that makes a lot of investors pretty hesitant to do the work to write a $1 million check into an agribusiness in Africa, for example. And like I previously worked with Crossboundary, which I know is an investment advisory firm that has worked with USAID to sort of use donor funding to cover some of the costs of doing this type of deal work. And so I'm curious to hear your thoughts on sort of how this stands currently in terms of the ability for donor support to sort of bridge the gap in getting investors to be willing to write smaller checks. Yeah, just curious to hear if you have any thoughts on that. And Romi, that's probably most directed at you. And then the second question is, I think 2 other risks that we haven't really talked about are currency risk and commodity price risk, which are huge risks that prevent investors from investing in ag in emerging markets. And I think some of this is because like the markets for being able to like hedge, for example, are just not well developed in African countries. Also, like hedging commodities can be challenging and expensive. So curious to hear if there's like any innovative approaches to deal with these particular risks.
So thank you for your questions, also for mentioning cross-boundary and your work with them. We're currently working with them. I work closely with it's a secretariat called the Prosper Africa Secretariat. It's, believe it or not, all 17 government agencies trying to bring their tools and programs under the Prosper Africa banner to advance two-way trade and investment in the continent. And a lot of Prosper Africa's work for advancing that is through this ATI program that I was earlier referencing, and Cross Boundary is one of our partners. And a lot of what they do for us and with us is provide transaction facilitation support, which you may be familiar with, maybe had some experience with, where just what Nnaemeka is dealing with, all the things that you heard him, what takes time to go fundraise. Who should he be talking to? How many trips should he be doing? Does he, I'm going to get into the simple but important aspects of it. His slide deck, what are investors looking for? What's the pitch going to be for different types of investors? There's a lot of that, and looking at the business model and running the business model through a series of questions and vetting that Cross Boundary does for a number of entities. And there's a Prosper Africa website, and so any African business can seek out support, and we are providing it through entities like Cross Boundary. There's a need for a lot more of it, and to make those introductions, because I mentioned there are already a lot of funds that are operating. It's not known to those that are in the field. And so a big part of it, and Nnaemeka already mentioned this earlier, is making those connections. But when there's a specific need, we can step in, or if there's a new fund, we can help it pay the structuring fees for it so that they can get through the steps that they need to. So DFC, I don't work for the DFC anymore, but currency risk, a lot of their guarantees and lending, so they do debt, equity, guarantees, et cetera, but a lot of it is in US currency, and that is who's bearing the brunt of that. And that's really, really important question. They have explored different mechanisms to be able to provide so that the risk can be hedged, provide the loans in local currency. The challenge with DFC's Nnaemeka would be in conversations maybe for 14 months, and he doesn't have 14 months because I don't know what runway he has in terms of his financing. The point is, those tools need to be better developed to support businesses in a more timely fashion, and they currently aren't. So DFC's been trying to do more of local currency lending, because foreign currency, if any of you have been watching that as well, has been a huge issue. The dollar is very strong, and that's making it very, very difficult in many parts of the continent for businesses to do business. But I don't have a great answer for you. I do think the cross-boundary relationship has been really fruitful for us, because it's helping us with investment advisors. They have a number of offices throughout the continent. You have to really be on the ground. Nnaemeka knows this. There are just businesses everywhere with great ideas, and we don't have that capability. And nor should we be the ones doing all that work. It's better to partner with the right private sector entities that can help us source the deal opportunities or help us make those connections. But the transaction facilitation support is actually coming out to be something that we're doing a lot more of, because that's what's needed to help bridge the gap. So I'll offer that, and happy to discuss more offline. I don't know if any of you have other thoughts to share on.
I'll say just very briefly that just to answer to the currency risk question, that a couple of instruments that have come through the lab in past cycles, it's been a while now, were currency hedging instruments. At least one that came through, I think, prior to the lab already was operating but didn't have a climate focus, since that was the lab's value add, was bringing a climate focus to what could it look like to hedge renewable energy projects, et cetera. And then to the local currency point, I think that is also has been an increasing part of the lab focus is, for example, working on a debt capital markets instrument almost entirely in Rand. So focus just on South Africa and other Rand-based countries as a way to sort of have a secondary mechanism for managing currency risks, which is just to focus on local markets. Obviously that has challenges of its own in terms of access to capital, but yeah, two thoughts from the lab. context.
Great. Well, the conversation doesn't end here, but the panel does. So, but please join me in thanking the panel. They've been, extremely generous with their view. But they've just started this conversation, and we will continue with a few more events this evening when we will get a chance to have continuous conversations on the table and over some drinks and so on. So again, thank you very much. Thanks for your generosity.
Thank you
Thank
very
you.
much, Akash.